The dollar is widely expected to experience moderate ups and downs over the next month, rather than moving sharply in one clear direction. This outlook reflects a combination of global economic uncertainty, shifting interest rate expectations, and ongoing geopolitical developments, all of which continue to influence investor behavior in currency markets. Instead of a strong rally or a steep decline, the dollar's movement is more likely to be range-bound, reacting to short-term news, data releases, and changes in market sentiment. One of the main drivers behind this expected volatility is global economic uncertainty. While some economies show signs of stabilization, others continue to struggle with slowing growth, weak consumer demand, and structural challenges. Major economies such as the United States, Europe, and China are at different stages of economic recovery or slowdown, creating mixed signals for investors. In such an environment, the dollar often fluctuates as investors shift capital between safe haven assets and higher-risk opportunities depending on the latest developments. Interest rate expectations play an especially critical role in shaping the dollar's short-term direction. Markets closely monitor central bank messaging, particularly from the U.S. Federal Reserve, for clues about future policy decisions. Even small changes in expectations regarding rate cuts, pauses, or continued tightening can trigger noticeable movements in the dollar. If investors believe interest rates will remain higher for longer, the dollar may receive short-term support. However, if expectations shift toward easing, the dollar could face pressure, leading to pullbacks rather than sustained declines. At the same time, inflation trends remain a key uncertainty. While inflation has cooled from previous peaks, it has not disappeared entirely. Persistent price pressures in certain sectors could force policymakers to maintain a cautious stance, keeping markets on edge. Each inflation report becomes a potential catalyst for short-term volatility, as traders adjust positions based on whether the data suggests progress or renewed risks. These reactions often result in sharp but temporary moves rather than long-lasting trends. Another factor contributing to moderate fluctuations is labor market performance. Employment data, including job creation, wage growth, and unemployment rates, strongly influences expectations around economic strength and monetary policy. Strong labor data can boost confidence in the economy and support the dollar, while weaker numbers may raise concerns about slowing growth. However, because recent labor data has shown mixed signals, the dollar is more likely to oscillate as markets interpret each report cautiously. Geopolitical developments also remain a persistent source of uncertainty. Ongoing conflicts, trade tensions, and diplomatic disputes can quickly shift market sentiment. During periods of heightened geopolitical stress, the dollar often benefits from its role as a global safe haven currency. Investors tend to move capital into U.S. assets when uncertainty rises, supporting the dollar. However, when tensions ease or risk appetite improves, capital may flow into emerging markets or higher-yielding assets, slightly weakening the dollar. These shifts tend to be short-lived, contributing to choppy price action rather than a clear trend. Additionally, global risk sentiment plays a crucial role in risk-off environments. The dollar usually strengthens as investors seek safety and liquidity. In risk-on conditions, the dollar may soften as traders pursue growth opportunities elsewhere, because markets are currently alternating between optimism and caution. The dollar is likely to reflect this indecision through frequent but controlled price swings. The performance of other major currencies also influences the dollar's movement. The euro, yen, pound, and emerging market currencies all respond to their own economic and political factors. When other currencies face weakness due to domestic challenges, the dollar may appear stronger by comparison. Conversely, improvements in foreign economies can reduce demand for the dollar. This relative nature of currency markets means the dollar's movements are often more about comparisons than absolute strength or weakness. Another important consideration is market positioning. Many institutional investors and traders already hold significant dollar positions, limiting the potential for extreme moves unless a major surprise occurs. When markets are heavily positioned, reactions to news tend to be more restrained, as traders wait for confirmation before making large adjustments. This contributes to the expectation of moderate, short-term fluctuations rather than dramatic shifts. Technical factors also support the idea of range-bound movement. Key support and resistance levels in the dollar index act as psychological barriers, causing price action to stall or reverse when these levels are tested. Without a strong fundamental catalyst to break through these zones, the dollar is likely to continue moving sideways with temporary spikes and pullbacks. Furthermore, seasonal patterns can influence currency behavior. Certain times of the year tend to see lower liquidity or increased hedging activity, which can exaggerate short-term movements without changing the broader trend. As a result, the dollar may experience brief surges or dips that fade quickly as normal trading conditions resume. It is also important to consider the role of expectations versus reality. Much of what drives currency markets is not just economic data itself, but how that data compares to expectations. Even positive news can weaken the dollar if it fails to exceed forecasts, while slightly negative data may have little impact if markets were already prepared for it. This dynamic often leads to short-term volatility that lacks follow-through. In summary, the dollar's outlook for the next month points toward measured volatility rather than a decisive trend. Global economic uncertainty, evolving interest rate expectations, inflation dynamics, labor market signals, and geopolitical risks all interact to create a complex and shifting environment. These forces are likely to push the dollar higher at times and lower at others. But without the momentum needed for a sustained breakout, for traders and investors, this means the focus should be on short-term catalysts, risk management, and flexibility, rather than betting on a strong directional move. The dollar's behavior is expected to reflect caution, balance, and responsiveness to incoming data, making it a market defined by short-term fluctuations rather than long-term conviction in the near future. Key economic indicators such as inflation data, central bank signals, and employment reports will play a decisive role in shaping the dollar's performance in the coming period. These indicators collectively influence how investors assess the strength of the economy, the direction of monetary policy, and the overall attractiveness of the dollar relative to other major currencies. Rather than responding to a single factor, currency markets tend to react to the interaction of these data points, which often results in nuanced and short-term movements instead of dramatic one-sided trends. Inflation data remains one of the most closely watched indicators in financial markets. Inflation directly affects purchasing power, consumer confidence, and central bank decision-making. When inflation readings come in higher than expected, markets may interpret this as a sign that price pressures remain persistent. In such cases, investors often assume that central banks will maintain a more cautious or restrictive stance on monetary policy. This expectation can support the dollar, as higher interest rates or the prospect of rates staying elevated make dollar-denominated assets more attractive to global investors. However, the relationship between inflation and the dollar is not always straightforward. If inflation rises too quickly, it can raise concerns about economic overheating or reduced consumer spending power. In those situations, markets may begin to worry about long-term growth prospects, which could offset any short-term support for the currency. As a result, inflation data often triggers initial reactions that may later be reassessed as investors consider the broader economic implications. On the other hand, lower than expected inflation data can place temporary pressure on the dollar. Softer inflation readings may suggest that price stability is improving, which can increase expectations of future interest rate cuts or policy easing. When investors anticipate lower returns on dollar-based assets, demand for the currency may decline slightly. Still, such moves are often limited, particularly if inflation remains within a range that central banks consider manageable. Markets tend to react most strongly when inflation data significantly deviates from forecasts. Closely linked to inflation is central bank communication, especially signals from the U.S. Federal Reserve. Central banks play a critical role in shaping currency trends through interest rate decisions, policy statements, and forward guidance. Even subtle changes in language, such as shifting from a hawkish to a more neutral tone, can influence market expectations and currency valuations. When central banks emphasize the need to keep monetary policy tight to control inflation, the dollar often benefits from increased investor confidence. Higher interest rates tend to attract foreign capital seeking better yields, which increases demand for the currency. Conversely, if central bank officials signal that inflation risks are easing, or that economic growth needs support. Markets may anticipate a more accommodative policy stance. This can lead to short-term dollar weakness, as investors adjust their positions accordingly. It is important to note that expectations matter as much as decisions themselves. Markets often price in anticipated policy moves well before they occur. As a result, the dollar may react more strongly to changes in central bank tone than to actual rate decisions that were already expected. This dynamic explains why currency movements sometimes appear counterintuitive. With the dollar weakening after a rate hike or strengthening after dovish remarks, depending on prior expectations, employment reports represent another key pillar influencing the dollar's outlook. Labor market data, including job creation, unemployment rates, and wage growth, provides insight into the underlying health of the economy. Strong employment numbers generally signal robust economic activity, which can support consumer spending and overall growth. When job data exceeds expectations, investors often view this as a positive sign for the economy. It's potentially strengthening the dollar. In particular, wage growth is closely watched because it can feed into inflation. Rising wages increase household income, but can also lead to higher production costs and consumer prices. If employment data suggests that wages are rising rapidly, markets may expect central banks to maintain a tighter policy stance, lending support to the dollar. However, if wage growth slows while employment remains stable, the impact on the currency may be more muted. Conversely, weaker employment data can put temporary pressure on the dollar. Rising unemployment or slowing job creation may raise concerns about economic momentum. In such scenarios, investors may anticipate policy support in the form of rate cuts or other measures to stimulate growth. These expectations can reduce demand for the dollar in the short term. Still, the effect is often limited unless labor market weakness appears sustained or severe. The interaction between inflation, employment, and central bank policy creates a feedback loop that drives short-term currency movements. For example, strong employment data may boost inflation expectations, influencing central bank signals, which in turn affect the dollar. Similarly, cooling inflation combined with softer job growth could reinforce expectations of policy easing, placing pressure on the currency. Markets continuously reassess these relationships as new data becomes available. Beyond domestic indicators, global economic conditions also shape how markets interpret U.S. data. If other major economies are facing slower growth or higher uncertainty, even modestly positive U.S. data may appear relatively strong by comparison, supporting the dollar. In contrast, if global growth improves and risk appetite rises, the impact of U.S. economic data on the dollar may be less pronounced as investors explore opportunities in other markets. Market sentiment and risk appetite further influence how economic indicators affect the dollar. In periods of heightened uncertainty, the dollar often benefits from its status as a global reserve currency and safe haven. Even mixed or slightly weak data may not significantly weaken the dollar if investors prioritize safety and liquidity. On the other hand, in risk-on environments, positive global sentiment can reduce demand for the dollar, even when U.S. data remains relatively solid. Another important factor is data consistency. One strong or weak report is rarely enough to change the broader trend. Markets look for patterns and confirmation across multiple releases. For instance, a single soft inflation print may not significantly weaken the dollar if subsequent data shows stability. Similarly, one strong jobs report may not lead to sustained dollar strength if other indicators suggest slowing growth. This explains why dollar movements often remain temporary and range-bound in the absence of clear, consistent signals. Investor positioning also plays a role in how economic data impacts the dollar. If markets are heavily positioned in favor of the dollar, even positive data may lead to limited gains, as much of the optimism is already priced in. Conversely, if sentiment toward the dollar is overly cautious, positive surprises can trigger sharper short-term moves as traders adjust their positions. Over time, the cumulative effect of inflation trends, central bank signals, and employment data helps define the broader narrative around the economy. In the near term, however, these indicators are more likely to cause incremental adjustments rather than dramatic shifts. Positive data may strengthen the dollar slightly, while weak data may introduce temporary pressure. But sustained trends typically require a clear and consistent change in economic direction. In conclusion, key economic indicators will remain central to the dollar's performance, guiding investor expectations and market behavior. Inflation data shapes perceptions of price stability. Central bank signals influence interest rate outlooks. And employment reports reveal the economy's underlying strength. Together, these factors create a dynamic environment in which the dollar responds to new information with measured, short-term movements. Rather than expecting sharp or one-directional moves, market participants are likely to see a currency that reacts cautiously, adjusts gradually, and reflects the balance of economic signals as they unfold.